Good morning, everybody. Welcome back to another weekly general update on the markets. And I'm changing the theme a little bit this week. Whilst I'm extremely positive in the medium term about where markets are going, I think we're close to a bit of a corrective phase in the market. So I think this is a bit of a time for caution. So let's have a look at first of all the trading results that we've had this year. Now, as regular viewers will know, on the first weekend of the month I put our trading results up, and the profit is based on a 20,000 portfolio is 6,750 based on the closing prices on the 1st of November. That's on a trading float of $20,000. It's backed off a little bit from when I last did this a month ago. That's based on a risk per trade of $300, and we've taken 53 trades so far this calendar year. Now, the win rate is still a very healthy 69%, and the win-loss ratio 1.77 to 1. The profit has come back just a little bit in the last month because a couple of the very profitable trades that we've still got running just pull back a little bit, but that should only be temporary. Now, any trader will tell you that a win rate of close to 70% and a win-loss ratio of getting up towards 2 is really robust trading conditions. So very pleased with those trading results this year. Now let's get on and have a look at summary of the week, and there's a couple of really clear and straightforward messages this week. One to do with stocks and one to do with gold. The S&P index only rose 2 points on the week. It's been running hard for quite some time now, and this is the longest run that we've seen in both days and also in distance. It's about as far as the market ever goes before we get some sort of correction. So that's one reason that I'm just turning a little bit cautious on the market in the short term. And the second reason is that the broader market in America, the Russell 2000 index, which covers the small to mid-cap stocks, is also finally showing some signs of weakness relative to the other indices. The Russell 2000 has been so strong all year. In fact, it's outperformed the S&P all year. And just in the last couple of days, seeing a little bit of weakness. So I think that's a bit of an early warning sign. Now, it would be normal for the American market to pull back perhaps 3 to 8%. So that's roughly a 50 to 150 point correction in the S&P index. Might bring it back to somewhere around about 1600. And then I think once that corrective phase is out of the way, then it would be a pretty good opportunity to really pile back into the market. So let's have a look at the S&P index. You can see the moving average still heading up quite strongly. The index has remained above that moving average, but you can see the number of days in this last run higher is about as far as it ever goes. It might push up towards 1800. We might get another week of gains. But I really think it's getting to a point where you don't want to wait for the market to turn and then try and get yourself out of the way, because that first day could be a bit nasty. So I think it's better to get out in advance. We're also seeing some signs of a bit of weakness in the Australian market in the last 2 days, and I think they're all warning signs that it's probably best just to pull back a little bit. So you'll see over the so the S&P actually went up on the week by a small amount, and you can see it was positive on Friday night. Just zoom in on there so that that's clearer. Now let's have a look at the Russell 2000 index. So if we pan back, you can see it's also been a very strong trend, in fact even stronger trend really than the S&P. But the last 2 days really quite negative by comparison with the S&P, and it actually finished down on the week. Now, I haven't said that for a long time. So they're the indicators that I think are probably pointing towards the fact that markets will come off a little bit, and that'll be a good thing, and that'll set up some terrific trading opportunities. Let's look at the Australian market. Rose by 35 points on the index, but outside the top 10 or 20 stocks, particularly on Thursday and Friday, starting to see some weakness, some surprising weakness on Friday, and lots of stocks that had been overvalued are starting to close on their lows. So just for the sake of the exercise, let's have a look at the ASX 200 index, and you can see quite strong during the week, and whilst the index didn't show any sign of weakness on Thursday and Friday, certainly there were lots of stocks that did. So we don't really have an index that reflects that, although we could look at the small ordinaries index. Let's just have a look at the small ordinaries index, and you can see Friday, a couple of fairly negative days. Tuesday and Friday last week were quite negative on that small ordinaries index. So just some early warning signs there. Now moving on to gold, and this is important. Gold fell by $33 on the week. It had been caught in a downtrending channel for quite some time. It broke out of that channel the week before, which was a good sign. It got above 1340, which was the first key level that I was looking for. But then it's closed back below that level, and that just isn't a positive sign at all for gold. So I think there's a distinct possibility now that we might get one final thrust to the downside. I think that's highly likely in gold. So let's have a look at that chart. So you can see here, if you look at the red moving average line, clearly still pointing strongly to the downside. The price of gold has not been able to break through there. You can see we had this downtrending channel. We broke out of it, which was positive. We managed to get above this 1340 level through the week. We rallied up to the 150 day, and now we've turned over again and we've closed down inside that previous peak, that little short-term peak there. So the fact that the market has come back down under there, I think is quite a negative sign. That really shouldn't have happened. We should have moved up more towards the 1440 area if gold was indeed about to really start on its next run higher. So I think there's a distinct possibility we could see gold down under 1200 again. We're also not seeing any signs yet in the GDX index, in the gold stock index. And as I've said many times, you're generally going to see stocks move before the price of gold moves. And you can see there's just nothing there. We've had a couple of little moves, a couple of blips to the upside. And I think there's a possibility we might get a bit of a panic washout in gold stocks. They could really get dumped. And if that happens, that will be a terrific buying opportunity. But we're not there yet, so I would be extremely cautious about being in gold stocks. Now, copper rose slightly on the week to 329, so things on the broader economic front are still pretty positive. And oil still remains a bit under pressure, down to 95, and I think that's partly because of the amount of oil that's being produced in America now, and also the fact that tensions in the Middle East have backed off as well. So there's the 6-month copper chart. That's all we've been looking at now for quite some time. This just caught in this tight trading range between $3.20 and $3.30. So just to summarize, I think a short-term correction has to be a high probability. My guidance would be to get out ahead of it. It'll set up a terrific opportunity for trading the best stocks on our market, but you've got to be positioned well to capture that. And I would definitely stay away from trading gold stocks until we get some sort of final washout, and then I think that'll set up a terrific opportunity. So that's it for this week. As usual, if anyone would like to contact me and talk about the markets, about what we do with our trading and investing, then by all means do so. Contact me on that email address there. So that's it for this week. Cheers.